Imagine stepping beyond the familiar world of stocks and bonds into a vast landscape of unique and dynamic investment opportunities. This is the realm of alternative investments, an arena where everything from commodities and private equity to art and cryptocurrency offers new ways to grow wealth and diversify a portfolio. These investments invite the adventurous and informed to explore fresh potential, yet they also require a sharp understanding of their complexities. Today, we'll unpack the world of alternative investments, exploring how they work, their role in diversification, and what you need to know to navigate this uncharted terrain. Alternative investments encompass assets that don't fit neatly into the conventional categories of stocks, bonds, or cash. They include commodities, hedge funds, private equity, real estate, collectibles, and cryptocurrencies. Each offers its own unique set of opportunities and risks, often operating independently from traditional markets. Commodities, such as gold, oil, and agricultural products, serve as a hedge against inflation. Hedge funds, known for their exclusive nature, use diverse strategies like short selling and leverage to generate returns, aiming for performance regardless of market conditions. Private equity gives investors access to non-public companies, providing capital to businesses poised for growth or turnaround. Unlike traditional investments, alternatives offer a different type of growth, often requiring specific expertise and a high tolerance for risk. Commodities represent the essential raw materials that drive industries worldwide, from energy to agriculture. Investing in commodities can be a way to protect against inflation, as their prices tend to rise when the cost of goods and services increases. Commodities provide a tangible connection to the global economy, with prices influenced by factors like geopolitical events, weather, and supply chain dynamics. However, the commodities market is highly volatile, requiring investors to have a good sense of timing and risk management. For example, oil prices can spike due to political instability, while agricultural prices might fluctuate based on weather conditions. Despite the risks, commodities appeal to those looking for direct exposure to the foundational aspects of the global economy. Hedge funds are private investment pools known for their sophisticated strategies and pursuit of absolute returns, meaning they aim to make profits even when traditional markets are struggling. Hedge funds use techniques like short selling, betting that a stock will drop, leverage, and derivatives to generate returns. These strategies can lead to substantial profits, but they also come with high risks and fees. Hedge funds often charge both management fees and performance fees, meaning investors pay extra when the fund performs well. Due to high minimum investment requirements, hedge funds are typically accessible only to wealthy individuals and institutional investors. They also lack transparency compared to other investment options, making them suitable for investors who are experienced, knowledgeable, and comfortable with risk. Private equity provides capital to companies not listed on public stock exchanges. This funding might take the form of venture capital for startups, growth capital for expanding businesses, or buyouts for companies undergoing restructuring. Private equity investments are generally long-term, requiring investors to lock in their capital for several years. The appeal of private equity lies in its potential for substantial returns, especially when investing in companies with high growth potential. However, these investments are illiquid, meaning they cannot be quickly converted into cash. Additionally, assessing the value and potential of private companies can be challenging, requiring detailed analysis and due diligence. Private equity is best suited for investors with the expertise and patience to ride out the lengthy investment period. In a diversified portfolio, alternative investments can act as a stabilizing force. Because they often have low correlation with traditional markets, alternatives help smooth out the impact of market volatility. For instance, real estate might perform well when stocks are down, and commodities can provide a hedge during inflationary periods. Including alternatives is like adding different instruments to an orchestra, creating a fuller, more resilient performance. Real estate, for example, is influenced by factors like local demand and development trends, which differ from those affecting stocks. Gold has traditionally been seen as a safe haven asset during economic uncertainty. Hedge funds and private equity, with their specialized strategies, add further layers of diversity and growth potential, providing returns even when stock markets are struggling. However, integrating alternatives requires careful selection. The illiquidity of assets like real estate and private equity means that funds are often tied up, making it challenging to access cash when needed. Diversifying with alternatives is about balancing your portfolio in a way that matches your risk tolerance, time horizon, and financial goals. Alternative investments are known for their potential to provide higher returns than traditional assets, but they also carry unique risks. Real estate, for instance, offers rental income and appreciation potential, yet comes with challenges like property maintenance and market fluctuations. Commodities like gold or oil can hedge against inflation but are also subject to rapid price swings. Investing in private equity and hedge funds can lead to significant gains, but they demand an understanding of complex strategies and often require high capital and a long-term commitment. Cryptocurrencies, with their extreme volatility, offer a unique blend of high-risk and high-reward opportunities, making them attractive to investors looking for diversification from conventional financial systems. Another risk with alternatives is their lack of regulation. Markets for assets like collectibles and art are less standardized, making it difficult to assess true value. Additionally, alternatives are often illiquid. Unlike stocks that can be quickly sold, assets such as real estate and private equity are more challenging to exit without losses. Informed investors manage these risks through careful research, expertise, and a willingness to ride out periods of low liquidity. Investing in art, wine, and collectibles merges financial gain with passion. Collectibles are assets that hold cultural or historical significance, from rare paintings and vintage wines to stamps and memorabilia. The value of these items depends on rarity, condition, historical importance, and demand. Art is unique among assets because it represents historical or emotional significance. Paintings by renowned artists can gain significant value over time, though the art market is highly nuanced and requires expertise. Wine, particularly from prestigious vineyards, appreciates as it ages, with value influenced by vintage and storage conditions. Collectibles offer investors a deeply personal connection to their investments, though these markets are speculative and less liquid than other asset classes. For those interested in art or collectibles, thorough research is essential, often involving consulting experts and understanding market trends. The growth of digital platforms has democratized access, allowing investors to buy fractional shares of art or collectibles, making this investment path more accessible than ever. Cryptocurrencies have rapidly gained prominence as alternative investments, challenging traditional financial systems with decentralized digital assets. Cryptocurrencies like Bitcoin and Ethereum are powered by blockchain technology, a decentralized ledger that secures transactions. This technology ensures transparency, security, and freedom from central bank influence. Investing in cryptocurrencies offers the allure of high returns, with prices capable of dramatic swings within short periods. Some investors view cryptocurrencies as a hedge against traditional financial systems, particularly during economic uncertainty or inflationary periods. However, the crypto market is extremely volatile and lacks the regulatory protections found in conventional assets. Additionally, the security of digital wallets and keys is paramount, as digital assets are vulnerable to hacking. The rise of decentralized finance, DeFi, which operates financial services on the blockchain, has expanded cryptocurrencies' role in alternative investments, allowing users to lend, borrow, and earn interest on digital assets. For investors ready to explore this digital frontier, cryptocurrency offers diversification and high reward potential, but demands a deep understanding of both technology and market trends. Navigating alternative investments requires careful due diligence, a thorough analysis to uncover the true nature and risks of potential investments. This involves evaluating the fundamental aspects of each asset, from property location in real estate to the provenance of a rare art piece. For hedge funds and private equity, understanding the fund's strategy, track record, and fees is critical. Risk assessment is essential. Alternatives often operate in less regulated markets, and they require investors to assess how these assets align with their risk tolerance. The complexity of alternatives makes knowledge and expertise vital for managing risks effectively. Regulatory and tax implications must also be considered, especially with newer assets like cryptocurrencies, where regulations are still evolving. Investors seeking to diversify with alternatives should view each asset within the context of their broader portfolio, ensuring a balance between traditional and alternative assets. With the right approach, alternatives can enhance diversification, protect against market volatility, and provide new sources of growth. Alternative investments offer a powerful way to expand beyond traditional stocks and bonds, providing unique assets and strategies that enrich a portfolio. From commodities and private equity to art and cryptocurrency, each alternative brings its own blend of risks and rewards, allowing investors to navigate market fluctuations with greater resilience. Yet, this journey requires careful research, a deep understanding of each asset's characteristics, and a strategy that aligns with long-term goals. With diligence and expertise, alternative investments can unlock opportunities for growth, stability, and a diversified portfolio that thrives across economic cycles. For those ready to embrace this exciting path, the world of alternative investments awaits, offering the chance to build a more robust and multifaceted financial future.